DMart disappointed many investors. The stock did not give the kind of returns people expected. Excitement cooled down, confidence reduced, and now people are thinking one simple thing. If stock already disappointed, then maybe now it is cheap. But what if the belief is dangerous? What if DMart can be great company and still be expensive stock? What if many investors are about to repeat the same mistake again? If you owe DMart, want to buy DMart or are waiting for the right entry, watch this carefully because today we are not asking whether DMart is a good business. We are asking the real investor question. Is DMart still overvalued even after disappointing investors? First, let us be honest. DMart is still one of the strongest retail business in India. This is not a weak company story. This is not fraud story. This is not a debt problem story. DMart still has strong brand trust, discipline management, efficient operations, and customer base that respect value pricing. The company keeps expanding stores, revenue keeps growing, the business is alive and strong. So, where is the problem? The problem is price. This is where many retail investors fail. They think if a company is good, then the stock must be good. Wrong. A company and stocks are not the same thing. A company can perform well, but if investors already paid too much for that performance, returns can still disappoint badly. That is exactly why DMart became such an important case study. For years, the market gave DMart a premium valuation. Why? Because investors believed this company had rare qualities, strong execution, clean management, long runway, low cost model, predictable growth. So the market was ready to pay very high multiple for each rupee of earning. But here is the danger. When a stock gets premium valuation, it stops being judged by normal standards. It is no longer enough to be good. It has to stay exceptional. It has to keep surprising. It has to keep proving that future growth will remain strong. And the moment growth looks more normal, the valuation can compress. That means even if the company is still healthy, the stock can underperform. This is why many investors felt confused. They saw a strong business but weak excitement in sharp price. They thought something is broken, but often nothing is broken. The market simply changed the price it was willing to pay. Now ask the next brutal question. Has that risk fully gone away? And the answer is not necessarily. Because stock failing from extreme valuation does not automatically become cheap. A strong can move from crazy expensive to less expensive and still not be attractive enough to buy. This is one of the biggest trap in investing. Many people compare today's price with old high. They say it was much higher before, now it looks cheap. That is that logic is very very dangerous. The market does not care whether the stock came from high or low. The market cares whether earnings and expectations go next. Now let us get deeper. What does DMart need from here? It needs growth, strong enough growth to justify the premium. It needs store expansion that remains productive. It needs margin expansion that stays healthy. It needs customer loyalty that survives new competition. It needs investor to believe the best years are still ahead. That is a very high standard. And now competition is stronger than before. Quick commerce players are chasing habits. Customers now care about speed, convenience, app offers, instant delivery, and not only low price. That is very, very important. DMart can still compete, but the old games has changed. That matters because premium valuation depend on confidence in future dominance. If dominance became less certain, valuation became harder to defend. Now understand this clearly. I'm not saying DMart is a bad company. I'm saying investor must separate business quality from stock price quality. Those are two different things. A strong company bought too high can become dead money for years. A good company bought at wrong price can test your patience badly. A quality business is not a free pass to good returns. So what should investor watch now? Watch same store growth, watch new store productivity, watch margins, watch how management respond to changing customer habit, watch whether earnings growth became stronger than expectations. Watch whether valuation became more reasonable because if expectations stays too high and growth stays only decent, the stock may continue frustrating investors. Now the final answer. Is DMart still overvalued? Even after disappointing investors? My honest answer is this. DMart is still look like a quality company, but quality does not Remove valuation risk. If you buy only because it is famous or because it is already corrected, you may be thinking emotionally, not analytically. And in market, emotional buying is expensive. So before buying DMart, ask yourself one ruthless question. Am I buying a great business at a fair price, or am I paying too much for comfort? That single question can save investor from years of regret. If you want sharp stock analysis like this, subscribe now, like the video, because here we do not chase noise, we chase truth that can protect your money. Thank you very much. See you in the next video. Thank you.